Well, the fact of the matter is that the index fund has traditionally carried about 20% less risk than the average fund. In other words, for all the vaunted ability of mutual fund managers to raise cash, they've really been doing just the opposite. They had 14% in cash at the beginning of this bull market and 4%, only 4% at the peak. They were bearish when they should have been bullish and bullish when they should have been bearish. So the index at least steers a steady course.
Do you still expect, Mr. Bogle, that if this becomes what people call a stock picker's market, that the index funds will continue to outperform the stock pickers?
I don't think there's such a thing as a stock picker's market, Tyler. All investors are picking all stocks, and to the extent an index fund owns all stocks, it's a sort of contradiction in terms, because if the good stock pickers take all the good stocks, the other half of the market will be owned by the bad stock pickers who pick the bad stocks. It all comes out to a sum of one.
You know, we were talking last week on the program about mutual fund fees, how most people are happy to pay them when the market's going up because they're still making money. But as the market comes down, and especially as the net asset value of a mutual fund comes down, people maybe start to pay more attention to those fees, something that I know is very near and dear to your heart.
Yeah, the fees in the mutual fund industry, I'm sorry to say, are generally pretty outrageous. And you add to an average fee of 1.5%, at least another 0.5% for the fund transaction costs inside the portfolio, which isn't disclosed separately. And then mutual funds are tremendously, except for index funds really, tremendously tax inefficient. And the index fund is going to pick up another 1.5 on tax efficiency.